Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because we are still looking at gains once again as that rally holds into the new year. You're looking at all three of the major averages in the green. The Dow up just under 100 points, so just off the highs of the session. S&P up about 0.5%, nearly 0.5%. Nasdaq 100 once again the outperformer in today's trading action, although not by much. We're looking at gains of about 0.5% there. Taking a look at that sector action here, still a bit of a mixed picture. The clear winner in today's market action is communication services. That sector up well over 1%. Consumer discretionary materials not too far behind. In terms of the underperformers, utilities by far the underperformer today, off nearly 0.5%. Taking a look at some of those individual movers, I want to pull up some of those travel names. We got an upgrade from Morgan Stanley on Royal Caribbean here. That's really driving a lot of the action that we're seeing in some of these names. Royal Caribbean up just about 2%. Carnival also following suit, as well as Norwegian. Taking a look at some of the bank stocks, again, a lot of investors waiting for what we're going to get from banks as we kick off earnings season on Friday. We also got that inflation report on Thursday, so lots of anticipation heading into the final two trading days of the week. But you're still looking at a bit of a mixed picture with Wells Fargo trading to the downside. JP Morgan and Bank of America, though, still holding on to gains today, Dave.
Yeah, China, feels like the markets and frankly all of us just kind of holding our breath for CPI and to your point, bank earnings on Friday. Limited action until we see some evidence there. All right, let's get you up to speed now on more layoffs continuing to hit the economy. Crypto exchange platform Coinbase cutting about 1/5 of its workforce. That's about 950 employees after already announcing it would lay off 18% of workers in June. This is all part of a plan to slash expenses by about 25% for the quarter ending in March. CEO Brian Armstrong telling CNBC, quote, "The FTX collapse and resulting contagion has created a black eye for the industry," adding there's likely more shoes to drop. Investors cheering that news, as you might expect. Shares of Coinbase up more than 8% on the day, but still been a very rough go, down more than 80% over the last 12 months. Shauna, the question is, as we continue to see more layoffs primarily in the tech and specifically the crypto sector, will this represent some sort of beginning of layoffs, broader speaking, with the economy? We haven't really seen it, with a few exceptions. I guess you could throw Amazon into that a bit, but still really tech layoffs there. We haven't seen mainstream. We're not cheering for them, but in terms of a Fed story, they do need to see more job losses. Most think they need to see that unemployment rate about 5%. Right now, 3.5%.
And it's unclear how we're going to get potentially to that 5% level when you're looking at an unemployment rate that will not move higher, remains historically very, very low. When you take a look at the news today, I think we can categorize what's going on with Coinbase very similar to what we've seen from a number of those tech layoffs. This company scaled very quickly during the pandemic when it certainly did see a surge in activity and scaled way too quickly. And as a result, we're seeing a number of layoffs. Like you said, this is the third round of layoffs for Coinbase. And similar to what we've heard from Amazon, just taking a look at some of the other sectors here, Meta, Salesforce, over the last several weeks announcing layoffs, saying that they simply just scaled way too aggressively during that burst of activity. When it comes to crypto, though, the comments that we got from CEO Brian Armstrong, they really stuck out to me because this means that potentially some of that crypto winter that we have been discussing may not be done. The fallout from FTX, the collapse there, what that means industry-wide, maybe we could see potential competitors, Coinbase competitors, what he alluded to, going under over the next several months. And you got to ask yourself what that means for Bitcoin as we take a look at Bitcoin still above 17,000. I think the resilience that we have seen in Bitcoin, the fact that we haven't seen a larger drop over the last 2 months, has taken some people, really taken me by surprise, Dave.
Yeah, really, since that FTX collapse, when most thought the floor would drop straight out of Bitcoin and Ether, and it really has not. And in fact, to your point, it kind of feels like, looks like in the charts, like it's beginning to stabilize around that 17,000 mark and north of 17.3 today. So yeah, it looks like most of the damage has been done to crypto, largely speaking. And maybe there's some upside ahead, although, look, we've still got some more interest rates to come from the Fed. Generally speaking, not going to be good for the Nasdaq and high-risk sectors like crypto. So we'll see. I don't think anyone's jumping back in, but certainly appears to stabilize more than most expected.
Certainly has. All right, let's get to another big story of the day, and that's retailer Bed Bath & Beyond, maybe beyond saving. Q3 holiday numbers coming in worse than expected. Net sales crashing 33% from a year ago, while adjusted operating loss totaled $225 million. And that's not all. The company on track to close 150 stores, also laying off more employees. Some of those cost-cutting measures, one of the reasons why we're looking at gains today as we try to make sense of what this meme trade has really become. When you take a look at Bed Bath & Beyond, shares up about 25% today, just above $2 a share. For more on this, we want to bring in Jerry Storch. He's the CEO of Storch Advisors, also the former CEO of Toys R Us in Hudson's Bay. Jerry, it's great to see you. A lot to talk about when we're talking about Bed Bath & Beyond. Certainly a very dire report here from the company. It seems like they have run out of options. They're running out of options. From your perspective, though, how bad is it?
Well, actually, the company's been in trouble for many, many years. And there was some distraction from the whole meme craze and, the investments by Ryan Cohen, et cetera. But, essentially, they've lost their way for a very long time, didn't do what they had to do. And then they made it even worse with a strategic error of trying to go more towards private label, which is exactly the opposite of what they should have been doing. By the time they fired their CEO, early summer last year, it was probably already too late. And they've made some good strategic decisions since then, but it's probably too far gone and has lacked the sense of urgency around fixing the business for many years now.
So is it just a matter of when, not if, they file? And looking back on it, Jerry, it seems like the writing has been on the wall for, to your point, months now. What would have been saved had they filed 3, even 6 months ago?
Look, I don't, it's sort of, to me, it's not too productive day to talk about when they should file for bankruptcy. The sad thing is they should have fixed the business many years ago, and they were focused on all the wrong things during this period. The stock price was at absurdly high levels, you might recall, and they spent a ton of cash buying back stock at those ridiculously high levels when that was when they had their last best chance to save the company. Bed Bath & Beyond is a category killer. To be a category killer, you need to be the authority in your business. They lost that position so long ago, it's hard to remember. Keep in mind that at both Target and Walmart, of all categories they carry, home goods is the one they have the highest market share in. So they do very, very well in those categories. And over the last, I'd say 5 to 10 years, Bed Bath & Beyond lost its position as a place you had to go to find the best brands or the best products or the most complete assortment in the home space. And then for the last several years, they've sort of been monkeying around with dumping the brands and carrying own label, trying to be sort of an inferior version of Target, if you will. And when you walk in the stores, I know I went in, did some store checks last spring and wrote about the most damning material I've ever written to some of my investment friends, saying this thing is beyond saving. It's terrible. It was a horrible experience. The brands were gone. The private labels were unfocused and no good. It takes years to do what they were trying to do, even if it were the right thing to do, which it wasn't, which is to turn it into a private label shop. And the service was terrible. As they go through these rounds of cost reduction, all you do is cause a downward spiral, right? Because you go in the stores and they're even worse because there's no one to help you anymore. So you've lost the service element that an authority in the space needs to have. I mean, they did basically everything wrong you could do.
Yeah, I was astonished to go in earlier this week, just assuming I could pick up an ironing board. No such luck. You may have just answered this question, but who is poised to benefit from their exit?
Well, honestly, they're so small now. I don't think people are going to notice in the business when they go out of business. But it's Target, Walmart, and Amazon are the big players in their space. There really isn't a specialty player left, like in a lot of categories. Costco does very well. They'll pick up a little bit, but you won't notice it in the numbers of any of those retailers, frankly, because it's just too small. It's one of those things that seems like it should be bigger than it is, but it's lost so much market share over the years that it's going to go out with a whimper, not a bang.
So, Jerry, we have Bed Bath & Beyond potentially filing for bankruptcy soon. Also, the report last week, Party City is looking to potentially file for bankruptcy. What do you think this signals about this sector? And I guess in terms of the potential for growth of bankruptcies within retail this year?
Well, I felt for quite a while, I may have mentioned last time I was with you, that I thought there would be an increase in bankruptcies after the holidays in retailing. As you recall, before the pandemic, there were a lot of retail bankruptcies. This wasn't a new matter. And then the pandemic operated oddly enough to give people a sort of suspended animation or a timeout. And some companies, including Bed Bath & Beyond, did pretty well during the pandemic because their whole expense structure, the whole supply chain got changed. Everything was kind of weird. And now we're coming back out and we're renewing the old trend. So companies that didn't have a good strategy going into the pandemic don't have a good one coming out of the pandemic, and they're going to do very poorly. So I would expect to see a return to those days when you had an increasing concentration in retailing, increase in the winners. People like Walmart, Costco, Amazon, TJ Maxx, a great company. We're in a period now too where the consumer is strained and focusing on necessity. So you see the grocery companies doing very well. Costco's been doing well throughout all this period. People doing poorly, like the department stores. All this stuff about this department store, that one has solved their problems. That's totally absurd. When you look at it under any measure, all they've done is bleed massive market share to the point of almost irrelevancy. And they continue to have that poor performance. And they were the worst performing department stores and apparel stores were the worst performing segments over the Christmas holiday.
On the flip side, Babies R Us making, well, let's let you decide. Is it a comeback or is it just one store planned to open a flagship at the American Dream Mall, massive complex off of 95 in New Jersey? Is this one store or is it a comeback?
Oh, it could be a little something. But keep in mind, Toys R Us and Babies R Us used to be a multi-billion-dollar retailer. And then you have a company, nice people, who bought the license rights to the name, basically, and are licensing it to other people to open up stores or open up, for example, Toys R Us stores inside of Macy's. And it has nothing to do with the former company except for the name. I wish them well. I hope they succeed, but it's very unlikely that they're going to build much of a business. If you were going to build one, you wouldn't start with a store at a mall that's itself struggling, and there are many questions about the future of that mall, as you well know, where they thought, well, retailing is all about entertainment, so we'll make it an amusement park. Well, then it's an amusement park, not a retail location. And there are a few good stores in there. Most of them paid to stay in business by the developer, who themselves is trying to keep that mall open. So I don't think that means much of anything other than there was enough money to open a store.
Yeah, largely viewed as a water park at this point. Jerry Storch, good to see you, sir. Thanks for coming on. All right, just getting started here on Yahoo Finance Live. Still coming up, Meta and Amazon shares took a beating in 22. Are investors betting on a bounce back? See what JP Morgan's survey is revealing. And the creator of ChatGPT could be getting a hefty investment from Microsoft. The reporter behind this story tells us more. And a Coinbase analyst explains to us why he's still bullish on the stock. Don't go away.
Treasury Secretary Janet Yellen will be staying in her role. Bloomberg reporting that in mid-December, President Biden asked Yellen to remain in her post. There has been speculation that Yellen would leave her position following midterms. Yellen is likely to be a key figure in the administration, and Republicans are forced to battle over the raising debt ceiling. So Janet Yellen, Bloomberg reporting, staying in her role. Dave?
Stability, very good. Microsoft, meanwhile, reportedly investing a whopping $10 billion in students' favorite homework killer, ChatGPT. Let's talk about that with the reporter that broke the story, Semaphor's Liz Hoffman. Liz, good to see you. Tell us what you know about this investment, and effectively, will Microsoft become the owner of ChatGPT?
Yeah, thanks for having me. It's good to be here. I do think the right way to think about this is an M&A deal. I mean, $10 billion is just magnitudes larger than any venture, single venture investment that we've seen. And so, at the end, it's a complicated deal. We can talk a little about that if you want, but Microsoft will end up owning about half of this company and really sees it as just an incredibly important strategic bet on the future of technology.
Liz, let's talk about the details of that deal, because it is a little complicated just in terms of how much money they're getting over the number of years, and a lot of that tied to performance.
Yeah, I should say we don't know everything. We don't know what we don't know, and Microsoft has declined to comment on this. But it'll be phased in over a number of years. It also might include Microsoft had done an earlier investment in OpenAI in the form of credits, because the biggest cost, really the massive amount of money that ChatGPT spends, it spends on cloud computing, because every time, to your point, a student tries to get an essay written by a chatbot, or just like you and me who have found this incredibly fun and addicting, it costs the company like 2 cents every time someone uses it. So they're just bleeding money in server costs. So there's some serious cash coming in, but for them, cloud credits are almost as good. And Microsoft too is really buying market share for its cloud business, which is the number 2 behind Amazon. But that's an incredibly competitive business between Amazon, Google, and Microsoft. And a lot of these big companies who have a ton of cash have actually been using it to make investments. Remember, a couple of years ago, Google put $1 billion into CME, the exchange. As part of that, they were going to move basically a lot of their cloud computing needs to Google. So it's strategic in a bunch of different ways for Microsoft.
You mentioned that ChatGPT is bleeding money, in your words, on OpenAI, on ChatGPT. Is there plans to start charging for those transactions that you mentioned? I'm always surprised that I'm on there and it's not charging me. If not, what are the practical applications to begin profiting from this technology?
Yeah, that's always the problem with early stage companies. At some point, they need to figure out how to monetize. These guys have done an incredibly good job winning the attention game. And so they need to figure out how to flip that switch. The answer is there's a ton of applications. First of all, Microsoft, plans to use this in their software, right? We've made a lot of Clippy jokes in the last 12 hours. But they were very early to that game. Like, I see you're trying to do this. Can I help you, right? OpenAI, the code is so good. It can help people figure out how to do stuff in Excel, right? So it can really make sort of technical software that Microsoft sells just like a lot easier and more user-friendly, which will help them. But I've also talked to CEOs at unrelated non-tech companies who think this can be a game changer for customer service, for client relationship management, that kind of stuff. Just think about how much of Twitter is just people like standing in line at the airport and tweeting it, angrily at Delta. So there's a lot of applications, I think. And the one we haven't talked about, obviously, is search. Microsoft, Bing has been really an afterthought to Google for a long time. Interestingly, Google is very good. If you ask it a question, it will come back very reliably and point you to where you could find an answer. It's not that good at telling you the answer. It's trying to get better at that. You'll see some of their search results are a little more kind of natural languagey, but they're kind of clunky. And so, people really think this could be the future of search.
Yeah, Liz, I'm curious just to get your personal take on this, because Morgan Stanley was out with a note last month talking about, or I guess discussing more so how big of a threat ChatGPT could potentially be for Google and its search business. From what you know from all the reporting that you've done, do you think it's going to move the needle there?
I'll say two things. One is, it's a little bit like we've all been promised flying cars, and here we are, and we don't have them. This does feel like the next big thing in tech, right? You had the internet in the late 90s, you had mobile in the late 2000s, and kind of nothing since then. So, just at a high level, I think this is really directionally interesting. But then, the verdict from the market today, I don't know exactly where they are right now, but Microsoft opened about a point up and Google opened about a point down, and that's $35 billion of market value just swung between two tech giants. And by the way, it's not often you see investors in a company like Microsoft cheer them putting a huge amount of money into like a very nascent technology at an incredibly high price point. So clearly the market thinks this is a game changer and is happy that Microsoft is getting there first.
Liz, we haven't heard anything in the way of competition. Have you? And what is stopping someone else from getting in this game? It doesn't seem like there'd be a massive hurdle or barrier to entry.
That's always the problem with venture, right? How deep is the moat and how big a head start do you have? I guess it really depends on, there's a couple of things, right? Like, is computing power now a commodity? Like, maybe you could probably argue that it is. You've got the big players, the cost of cloud is always coming down. If you had like enough time to kind of feed the entire history of human interaction into a powerful enough computer, and you had enough money, I don't see why someone couldn't replicate this. I think that's a real concern here. That said, head starts are really helpful, and they have a very big one.
It'll be fascinating to see where this technology takes us. Liz Hoffman, always great to have you at 7-4. Thanks so much. Let's get to another story that we are watching. A new investor survey out from JP Morgan saying that investors think U.S. internet stocks are going to outperform the S&P 500 this year. And that's not all. Get this, the favorites among them, Meta and Amazon. Now, both of these stocks were down significantly over the last year. Meta falling just over 60%, Amazon down about 45%, but investors finding some tailwinds for both of these names. And more broadly, the sector citing attractive valuations, easing comps, improved margins. Dave, it caught me by surprise that Meta, 41% of investors think Meta is going to be a top performer. I think the only way you can justify that is strictly on a valuation basis, because when you take a look at Meta, nothing really has come out from the company in terms of the fact that they would be changing or pivoting their strategy going forward. Lots of blowback, lots of criticism on the company's focus on the metaverse, saying that is way too soon. They shouldn't be putting all their eggs in one basket at this point, and I don't see that changing. And you also have higher interest rates. It's hard for me to kind of wrap my head around the case that Meta is going to be the top performer here. I
hate to continue to agree with you on these subjects, but my immediate reaction was, huh? Meta? Now, they are suggesting that it's the ad environment that will be favorable to them, but that has been a very tough environment going back several months and looks to get a lot more difficult, if anything, in the year ahead based on digital ads and what we're seeing. And if you wanted to bet on anyone in that space, I think it's probably Google/Alphabet in that sector. In terms of sectors that they think will do well, these investors, they believe e-commerce is the best sector to invest in, which does give you some guidance why they pick Amazon there. We really just don't have a lot of insight why these investors feel it's Meta, because certainly there's no suggestion that the metaverse is going to have a strong 23. If anything, it's 5, if not 10 years away from success if it ever finds it. Amazon, you can see, because lost more than half its market value last year, and you have to bet on Amazon in the long run as they continue to bring their claws into everything we do, and e-commerce going to come back, still largely an AWS story for Amazon. I can't figure out why it is you'd want to bet on Meta. Now, I think largely this is compared to what they think the S&P is going to do, which these investors think it's going to be, quote, flattish. So if you think that the S&P is flat, maybe Meta and Amazon come back +5, +10%, and therefore making them a win. I was surprised also to see those very investors that bet on Meta bet against Netflix in the year ahead, because a lot of analysts in the last couple of days have been very bullish on Netflix. Yeah, they certainly have been. A lot of that tied to their new ad tier. They're very bullish, thinking that is going to be enough to kind of attract
new consumers and really up the usage that we're seeing in Netflix, which has really struggled in order to gain users and really have struggled to really post a substantial user growth in recent quarters and in recent years. We will see. I was very surprised by the fact that 43% of these investors think Netflix is going to be the worst performer of those mega caps, but we shall see. All right, coming up, Crocs anticipating a surge in revenue. We've got the details for you when we come back. Time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Sotera Health, Crocs, Molson Coors, Josh Schaefer here to help us break down some of these big movers. Let's start with Sotera Health. Shares are surging today. Look at that. Up 99%, the move to the upside coming after reaching a $408 million agreement to settle more than 870 legal cases in Illinois. Now, Sotera is a parent company of Sterigenics, which is accused of illegally releasing a cancer-causing waste at one of its facilities in Illinois. Now, the plant permanently closed back in 2019. Wall Street weighing in on the news. Let's talk about why a $408 million settlement is going to send shares surging by this amount. Barclays thinking that the settlement should be viewed as, quote, a risk-clearing event. KeyBank saying that the agreement is, quote, manageable outcome. This certainly does explain the massive jump that we're seeing in shares, which I guess have really been hindered by the fact that we didn't know how large potentially this agreement was going to be.
Yeah, Shauna, and I'll add to that another firm coming out too, Wolf Research, saying that this was, quote, far better than the street had feared and far earlier than reasonable minds expected. And they said the stock is, quote, ready to rock. And so it seems like people were sort of just waiting to see this headwind get cleared. I saw a bunch of different price targets sort of ranging from the stock maybe closer to fair value between $15 to $25 once this headwind gets cleared, and then you can sort of see how the business is operating. So I think good news clearly for Sotera Health today, up almost 100% now.
Yeah, which is incredible. Record.
My play, a little tough to match that today. Crocs out with a business update though, highlighting a better than expected revenues for 2022. Now, shares up really muted here, just under 1%, but the company expects to deliver revenue of approximately $3.55 billion for 2022, and that comes in about 1% higher than previously reported guidance and above consensus estimates. That reflects 53% year-over-year growth. The company's CEO, Andrew Rees, noting in the release strong consumer demand for not just Crocs, but also the brand Hey Dude, which they acquired during 2022, added to the company's revenues. And then he also noted that They've reduced their borrowing for that Hey Dude purchase by about $500 million now since acquiring them in early 2022. And Dave, I want to focus on Hey Dude a little bit here because it's an interesting part of Croc's story, maybe looking forward. So it was $232 million in revenue in the second quarter, $269 million of revenue in the third quarter. Curious to see what that goes to in Q4 when we talk about holiday sales. But that's almost 30% of Croc's overall revenue now is Hey Dude. They're kind of those fun loafer style shoes. I think we're showing some video of it right now, a little skater, Cali vibe. I don't know if you've seen them around the boat areas where you hang out.
Dave might have a pair.
Yeah, I feel like Dave might. Dave, you a Hey Dude guy?
It's funny, full disclosure, folks, Josh Schaefer told me about this brand earlier today, and I said, no, I've never seen them. And then I realized, I looked around the restaurant I was in. Sure enough, several people were wearing them, and I asked my son, he said, oh yeah, they're everywhere in our town. I was not aware of the brand. I have come since to find out they are all over the state of Connecticut. Saw them described in one financial outlet as the beer koozie of shoes, which is a brilliant description, and
Sounds
it looks to continue growing. Yeah, it looks to continue growing throughout this holiday season. I got one thing for you, Josh. About 30% also of Croc's revenue comes from international overseas sales. And I came across this photo in my research on Crocs. Artist David Hockney, he got to meet the king. Yes, the new king.
Okay.
And he chose what shoes? He wore yellow Crocs to meet King Charles. Check out that photo on your screen.
Those things pop, Dave. That's the thing with Crocs.
Imagine getting one chance to meet the king, and you got to go yellow Crocs. That's
You're going to stand out.
Making a statement.
I think the three of us need some Crocs, Dave. We'll go purple Crocs sometime.
I've still never worn them. The king said your yellow galoshes, he called them galoshes, were beautifully chosen. So I just love that story. We got to get some Crocs as I've never worn them. All right, my play is Molson Coors, whose company's been brewing beer for more than 150 years, as you know. But today, the beer maker getting in on the dry January theme, introducing Roxy. This is Roxy here. Let me just show you the cans. Comes in a very nice package with the term Zero Fox Given. What are they? They're the company's first ever zero proof canned cocktails. No alcohol in them from a beer maker. Molson Coors broadening beyond beer, seeking new growth categories. Jamie Weidman, the VP of Innovation for Molson Coors, says Roxy is built for those who want to moderate their drinking, abstain, or simply sip on something fantastic. End quote. 3 flavors, passion fruit, pineapple, and mango. Shauna, I'm back in the office tomorrow. Do you want passion fruit, pineapple, or mango?
Passion fruit. I'm going to go with that one, but they all sound delicious. And this is a home run. It makes so much sense for Molson Coors to be launching this product. We talk about the rise in non-alcoholic beverages and mocktails. And get this numbers here. Nielsen IQ is coming out saying that more than 70 new products were launched within this space last year alone. The market for non-alcoholic drinks grew more than 20% last year. Millennials, Gen Z really making up the bulk of those sales. So it certainly makes a lot of sense for names like Molson Coors to expand their presence within the industry, Josh.
And the one thing I'll say too is it looks like they really nailed the presentation there, Dave, with it looking like a cocktail. Because that's what people want, right? You want to be able to sit at the bar, have it look like a cocktail with that colored look so you can kind of feel like you're a part of the vibe that's going on there. Dave, you're trying it though. How's it taste?
The pineapple's outstanding. I was going to go passion because that's my favorite, but Shauna picked it. Josh gets the mango.
Mango, all right,
you
let's
get to take third place. Shares of TAP are up today and up 2.5% over the last 12 months, guys.
Ladies first. I like how this is working here to my advantage. All right, well, coming up next, big changes are afoot at vaccine maker Novavax. We're going to speak with the outgoing CEO Stanley Erck when we come back.
Welcome back to Yahoo Finance Live. Vaccine maker Novavax has announced that longtime chief executive Stanley Erck is stepping down from his position later this month. Before doing so, he joins us now with Yahoo Finance's Anjali Kamlani at the 41st annual JP Morgan Healthcare Conference. Anj, nice to see you.
Nice to see you too as well, Dave. And of course, with me is the man himself, Stanley Erck, CEO of Novavax for just a little bit longer, who has seen the company through quite an adventure through this pandemic. So, Stan, let's start off there. Really an interesting experience with Novavax in the last just 2 years alone. Talk to us about that. What has that been like for you?
So I think I mentioned to you that today is actually the third anniversary of when the gene sequence for COVID-19 was unveiled on the internet. And we and others started right then, that day, shifting our efforts from what was a flu trial, a phase 3 pivotal trial, over to COVID. And we had fewer than 100 people. We had less than $100 million. We had enough money to get through the next 5 months. And we were focused on flu. Since then, we've gotten the COVID vaccine, which I believe is the best-in-class vaccine because of its efficacy, its safety, its stability. We've done that in this 3-year period, and now the last year, we've gotten approved around the world, 47 different countries, all in the last 12 months. We are now at over 2,000 people. We have over $1 billion in the bank. We have funding to take it through commercialization. We are now a commercial company for the first time. We had $2 billion in revenue in 2022 for the first year, and that's pretty significant for a first-year commercial operation. And now we've got growth in the commercial operation that's going to take us to pass the pandemic stage, past the stage when we're selling product just to governments, until we get into the retail world, so the pharmacies. So.
Absolutely. And let's talk about that, because clearly your market has been to date ex-US, right? That's been
right.
how the trajectory played out during the pandemic. Talk to me about what that means for the company now. How much more of a struggle it's going to be for the inroads that need to be made in order for the U.S. market to recognize Novavax?
Yeah. So the U.S. has been last to come around and recognize to get the product licensed, to get it approved. And so we're just now there. We have to work with the FDA to expand the label so that we have it for all age groups and all boosting. But we're doing that, and so we'll get it done. It's too bad that it was the last country to do that, but nevertheless, that's behind us. And so we have a commercial organization that is as we speak educating the pharmacies of the U.S. On what this is. And so what we expect is that by the second half of this year, when we start looking at a fall vaccination, just like for flu, a fall vaccination for COVID or respiratory disease, we'll be ready and be able to commercialize it as a normal vaccine.
For the company moving forward, you now have a commercial product, someone new coming in to take the reins. What's plans for Stan?
I haven't had time to plan for Stan, and so Stan doesn't have a plan yet.
Stan doesn't have a plan. All right. Well, hopefully we'll see you back out there. You've had clearly a long history in the space. This is your 30th year at JPM.
Yeah.
How would you rate this one versus the previous ones?
Well, it's a bit quieter. It's a sleepier J.P. Morgan than I'm used to, but that's in some ways that's good. So I get to see people, old friends, and so
it's good. Okay. Great. Well, Stan, best of luck in everything that you do, and hopefully we'll see you around.
You will.
That's Stanley Erck, CEO of Novavax. Back to you guys.
All right, thanks so much, Anj. And of course, our thanks to Stanley as well. Well, coming up, our next guest believing that the future of work is going to look much different than it does today. Find out how next.
In a boundaryless world, work isn't defined by jobs, the workplace isn't a specific place, and many workers aren't traditional employees. That is not from the trailer of James Cameron's upcoming blockbuster film. That's from a massive study on the future of work. In it, Deloitte polled more than 10,000 business and HR leaders from more than 100 countries across every industry. Steve Hatfield is Deloitte's Global Future of Work leader. He joins us now. That was my best movie trailer voice. That's why I'm doing this for a living. Steve, good to see you. I want to break that statement in half and start with the beginning. A boundaryless world, work isn't defined by jobs. What do you mean by that?
Well, Dave, great to be here. Thank you for having us. And thank you for that introduction. So what we found in this latest trends report, and this is the 13th year of our trends report, so we've been watching these trends for that long, that there's a palpable shift from work being defined as something that's repeatable and something that's structured into something that's much more agile and much more fluid. And the boundaries around that are changing. And so we're moving from jobs to skills. We're moving from full-time employees to workers within an ecosystem. We're moving to a world where we're harnessing worker agency. And it creates this set of dynamics around the boundaries that we used to think of as those that drove how workforce and workplace were shaped have shifted.
And Steve, to that point, there's been a lot of talk about returning to the office. More and more companies, Disney's Bob Iger coming out yesterday saying employees need to be back in the office 4 days a week. Is that something that you think isn't going to stick and employees aren't then going to put up with if, in fact, there's a massive, massive priority and a massive emphasis on mobility and flexibility?
Yeah, the nature of the hybrid model, the demands of sort of the agility that we're talking about in the trends report, the way in which workers are all able now to sort of interact on digital platforms in our new digital workplace, it speaks to a trend of the workplace itself being very different, not being the place that we go to perform our jobs, not going to the place where we get the work done, but rather it's an input to the work itself. And so we're urging organizations to sort of clock into that, to think about, well, what work needs to be done in a physical location versus a virtual location, and tap into the workforce sentiment that's been really clear about them wanting the kind of flexibility that exists within a hybrid model. So in our Millennial and Gen Z study from earlier this year, 75% of them globally would want a hybrid work model. In our Women at Work study, it was 65%. And so when we look at the dynamics around the current trends report, we sort of see that the issues around this boundaryless world, this ecosystem-driven, digital workplace-enabled, skills-focused kind of work environment means that there are some real obstacles to getting that to happen. And one of them is actually legacy mindsets. It's the largest obstacle in the way of making these kinds of trends take place in the workplace.
So several questions arise from all that. But at the core of all of it is, what can we, employees, do to prepare for this? And what can employers do to prepare for this?
Yeah, it's a great question, Dave. So we think that there's a new set of fundamentals now, one that leaders and organizations need to clock into pretty quickly. So first, there's this need to think like a researcher, to bring much more experimentation to the table in terms of the reimagination of work, the reimagination of the workplace. Second, to co-create with your workforce, that level of worker agency, their degree of self-determination, the degree to which they actually have such an important stake in what's going on. Tap into that. Those organizations that co-create with their workforce are 2 times as likely to be more innovative, 1.5 times as likely to have a workforce that's more engaged and motivated. And then finally, this palpable shift that took place over the pandemic to humanize, to focus on human outcomes, and to help your project teams, to help your team leaders understand how they're humanizing and how they're elevating human outcomes to the fore in how work gets done.
Certainly sounds like a number of changes when we talk about the future of work. Steve Hatfield, thanks as always for coming on. Well, coming up, a stunning turnaround for Abercrombie & Fitch, the retailer once again winning over younger consumers. We're going to tell you how when we come back. The retail sector down more than 25% from a year ago, with a number of big brands struggling to navigate soaring prices and also a looming recession. Well, last week, CEO of Macy's revealing that the company's holiday sales would be at the low end of their initial guidance. Shares of Lululemon taking a tumble yesterday after the company warned that its profit margins were going to decline in the fourth quarter. But one retailer is coming out of the holiday shopping season on top, and that is Abercrombie & Fitch. Shares up about 1% today. We're looking at 2 days of gains of about nearly 10%. The move higher coming after the company raised its guidance. Net sales now expected to rise between 1% and 2%. The retailer has done a massive U-turn in recent years. Once known for its perfume stores, the shirtless models, A&F has certainly rebranded, and it seems to be working, Dave. They're really going after their bread and butter, the millennials, the Gen Zers on the older end of that generation who grew up shopping at Abercrombie & Fitch, but they're doing it in a different way now. Those tight clothes, everything that they were known for in the 90s, early 2000s. If you go into a store today, that's certainly not it. They have the baggy sweatshirts, the jeans that are the looser fit, and it seems to be working with consumers today.
Yeah, it's remarkable. We're talking about, 30 years after they were their hottest and now their best holiday sales ever. And in particular on that group, the Gen Z and the millennials, getting away from that sex sells, the shirtless models in the door that always brought people in. It's a very interesting comeback story, one that I'm not sure is about innovation as much as it is how the population has come back around. And I think it really comes out of COVID. People were home for so long, learned to be very comfortable, just one person's theory. Again, I take this all anecdotally from taking my kids to school, see a lot of Abercrombie & Fitch. Comfortable, loose-fitting clothes seem to be what they are wearing today, rather than the tight, small, skimpy clothing that we saw a lot going into the pandemic. American Eagle has also had a remarkable turnaround, second best holiday sales they've ever seen. Fran Horowitz really deserves a lot of credit for the turnaround there at Abercrombie. And what's interesting is people kind of buried this company with a Netflix documentary that pointed out how they were so discriminatory, even racist, and really exclusive, something they kind of owned. And then Fran Horowitz comes in and makes this a real inclusive brand. Everyone's welcome, taking away a lot of the logos, a remarkable turnaround in the retail segment, and looks to continue throughout the year.
And Dave, speaking of that U-turn, former CEO Mike Jeffries was quoted back in 2006, and this speaks to the Netflix documentary that you were just talking about. We go after the cool kids, we go after the attractive all-American kid with a great attitude and a lot of friends. Are we exclusionary? Exclusionary? Absolutely. And certainly the brand that you're seeing today, what's working with all their consumers today is certainly light years away from what it was under Jeffries in the early 2000s. All right, well, coming up, we are counting down to the closing bell on Wall Street. Again, all three of the major averages in the green once again today. Nasdaq up about 83. We'll be right back. We are minutes away from the closing bell. Let's take a look at some of the top trending stocks today. First up, we got to talk about Bed Bath & Beyond. You're looking at a gain of the last 2 days of about 54%. We need to point out it's just above $2 a share. The move higher today coming after the company reported worse than expected earnings. That sales drop of over 30%. Despite all that, investors seeing some optimism, I guess, in the fact that the company plans to close more stores, laying off more employees. It's hard to make sense of the recent moves that we have seen in Bed Bath & Beyond, Dave, over the last several months, last several years. Certainly has become a meme favorite. When you take a look at the performance over the last year, you're looking at losses of about 84%. Bed Bath & Beyond expected to file for bankruptcy. Jerry Storch telling us earlier in the program, Dave, they don't have any other option.
Yeah, it really is a question of when, not if. Closing 150 stores, there is no path to them finding their way here. And you got to just attribute this to a meme trade. You almost want to look up Wall Street bets on Reddit and see if that is driving the stock, because clearly Chapter 11 is right around the corner.
Certainly is. Right. Let's take a look at another big story that we are tracking, and Broadcom. That stock off just about 0.3%. The move lower coming after Bloomberg reporting that Apple will be replacing Broadcom's chips with its own in-house chip in 2025. Shares initially traded off on the news. They are well off their lows of the day, as you can see on that intraday chart. Taking a look at where Apple is trading. Apple holding on to gains as we enter the final minute of trading here, Dave. Apple up just about 0.4%.
Yeah, not everyone thinks this is as big a deal. On Tuesday, Stacy Rasgon reiterated his outperform rating on Broadcom, saying largely this is much ado about nothing. Says that several other relationships with Apple in terms of their parts arrangement will be a much bigger deal. Stacy, an analyst for Bernstein, so says pumping the brakes a little bit on how big a problem this will be for Broadcom.
Yeah, certainly. All right, let's take a look at another mover here to the upside, and that's Royal Caribbean. You're looking at gains of nearly 3%. The move to the upside coming after Morgan Stanley upgraded the stock to equal weight with a price target of $50 a share, still $8 below where it is trading today. Now, Morgan Stanley calling the company, quote, the superior cruise operator, but still highlighting the fact that the looming concerns around inflation, a slowing economy, that is a massive headwind here for the sector. Intraday jump up just about 3%. We're looking at a one-year chart when we certainly have talked about the fact that a number of the cruise lines remain under pressure. Dave, with the Royal Caribbean off about 26% in the last year.
The small sample size, the cruise stocks generally move together on one ship, and this year that ship is moving forward. Royal Caribbean's up 21%, Norwegian's up 19%, and Carnival's up 21%. So all of them moving to the upside. Let's get your closing bell on Wall Street. All right, there's your closing bell on Wall Street for this Tuesday, and nice to see a lot of green, all green on this board as the Dow raises 187 points, just over 0.5%. The S&P also finishes on the upside, up 27 points, and the Nasdaq, the big gainer on the day. Despite everything we make of this higher rate environment, usually the most sensitive to these higher rates, which the Fed has continued to reiterate are not going to be lowered in 23, up 106 points, more than 1% gainer on the day, Shauna.
All right, let's talk about what this could mean here for stocks for the remainder of the year. Certainly off to a strong start, if we want to call it that. We want to bring in Nancy Tengler, Laffer Tengler Investments CEO and Chief Investment Officer. Nancy, it's great to have you here in studio. So certainly has been a stronger start to 2023. Lots of questions about what the next couple of months are going to look like. What's your big takeaway of the trading action that we have seen so far and what that signals?
Well, Shauna, thanks so much for having me. I think a couple of things. We got oversold, and we wrote a piece at the end of the year that said we thought investors were too pessimistic, and we started adding some risk back into our portfolios. But I don't think we're done. I think we have to get through earnings season, and we will see some disappointments. We'll see a little bit of volatility, I suspect. But I think in the second half of the year, or by the end of the year, the market's going to be up in a not in a huge way, but in a normal way. Low double digits potentially, with volatility in the first half of the year. So we've been actively adding to different aspects, different sectors within our equity portfolios.
Yeah, Nancy, nice to see you. Dave here. A lot of are calling for 3,000, 3,200 low for the S&P. Do you think the bottom is in? And you talked about earnings. What do you expect we'll learn come Friday when the big banks start reporting?
Yeah, so I wish I knew that, Dave. It's good to see you. But I do think that, they should benefit from a rising rate environment. We think our favorite bank for 2023 is Goldman Sachs, because we think the volatility will help the trading revenues. We think you're going to start to see M&A activity pick up. A lot of companies, even with rising interest rates, have a tremendous amount of cash on their balance sheets. And there's some really attractive valuations out there for companies to snap up. So we think, they'll probably be a little bit better than expected, and that will at least put a nice floor under the market going into the rest of earnings.
Well, Nancy, even ahead of earnings season, you mentioned the fact that you were actively adding. What do you like right now, given all that uncertainty ahead?
Well, so we just initiated a position, Shauna, in Tesla. We thought that the sell-off had gotten overdone. We'd owned it years ago when Elon was in much bigger trouble than he is right now. Remember, he had SEC after him. He was sleeping on the floor of the plant. He was doing, podcasts, drinking whiskey and smoking a bong with Joe Rogan. And he was losing staff in a meaningful way. We learned, we took a double in the stock and we got out and we left a lot of money on the table. I think when you look at the growth, even with the demand slowdown, this is a stock you're going to want to own 3 to 5 years from now. Maybe not for the next 3 months, but that will give us an opportunity to add to our position. So that's one name on the risk side. And then on the non-risk side, we're generally, the majority of our assets are in dividend growth strategies. So we're adding 2 names like Oracle. We're adding to Chubb. And so a little bit of non-risk and a little bit of risk, and we're barbelling our portfolios accordingly.
And Nancy, the markets continue to move up and down with just about every time a Fed official opens his or her mouth. You are listening to the bond market. What is it telling you is around the corner?
So the bond market is having a big fight with the Fed right now. I think it's telling us that the Fed is not going to be as aggressive as they say they are, that we may, in fact, get a recession, but it won't be terribly deep. My money is on the bond market, because let's not forget that the dot plots that were Fed's own predictions in December of 2021 didn't even see us getting to 3% yield until 2024 on the Fed funds rate. And so I think we have to keep that in mind. This is a Fed that's been wrong at every major turning point, beginning with when Chair Powell took over in 2018. I mean, his first bear market was in 2018, early October to Christmas Eve. So I'm suspicious that the rhetoric isn't going to match up with their actions. Now, I know a lot of people disagree with me on that, but I do think the bond market I'm in their camp. They're not in mine.
Well, Nancy, that's interesting, because it seems like the markets believe what you are saying, because anytime we get a hint of dovishness, not even dovishness, that they're not doubling down on the most hawkish stance that we have heard over the last several months, we certainly have seen a bump up in the market. So if you don't think the Fed is going to be as aggressive as they're signaling right now, what are you expecting then at the next meeting? And then do you think they're going to pause?
Yes, I do. I mean, if you look at they became data dependent in 2020 at Jackson Hole, which means they're looking backward to make policy for the coming quarters and years. But if you look at the actual data, PMIs have rolled over. Prices paid, which are highly correlated to CPI, fell off a cliff last month. Shipping costs are down. Rents are coming down. Wheat, corn, commodities, energy. So I think they're going to be faced with the fact that CPI is going to come in better. And if you look at the 3-month backward-looking annualized, not the number that gets quoted, which is a trailing 1-year number, but the annualized rate is about 3.5% for CPI. That's already below the funds rate. So I think the risk is that there's maybe some ego, legacy involved. I don't think we should be setting Fed policy that way, but the data would indicate that they've done enough, and let's let the lagged effects come in. So I think 25, you're starting to hear that come up, but it doesn't even matter. We're closer to the end for sure than we were even just a few months ago.
Let that medicine do its work. Nancy, nice to see you. Thanks so much.
Yeah, thanks, David.
All right, Warner Brothers Discovery, a trending ticker today on Yahoo Finance today after receiving some love from Wall Street. Bank of America adding the stock to its US One list saying the media giant has, quote, long-term potential. Also, Goldman calling WBD its favorite media stock. Joining us now with more on this is Yahoo Finance's Ali Canal. Ali, why is it their favorite stock?
I mean, this is crazy. The stock closed more than 8% higher today. Since December 28th, the stock is on a tear, up 30%. And this is after a pretty disastrous 2022. But there's a few reasons why both Bank of America and Goldman have this increased optimism around this company. Number one being the fact that we've reached several merger milestones, and that should ease some of those profit pressures. We will also have the streaming relaunch in the spring, reportedly called Max, and that should be a big driver when it comes to Warner Brothers Discovery's direct-to-consumer division. But if we go back to 2022, the stock lost close to 60% in the year, and that was amid various restructuring charges, macroeconomic challenges, further subscriber losses in linear television, and a slowdown in advertising. Bank of America did say in their note that advertising will likely pressure earnings when we get those results next month from WBD. But for now, investors seem pretty confident in the future, at least in 2023. And I think it's this improving narrative that's leading to the stock price today.
Ali, let's also talk about Disney since we have you here on set getting some attention. Guggenheim was out with a new note today making some revisions just in terms of their expectations for the current quarter and also the international launch of Disney Plus, the ad tier there, right?
Yes, and they're saying that is not going to happen until 2024. Another key update here from Guggenheim is that the disappointing performance of Strange World, that was that animated movie from Disney, and we really haven't seen that big Moana or Frozen type of film in quite some time for this company, but that was a huge disappointment. It only earned about $70 million in domestic ticket sales, about half of its reported production costs, so it actually lost money, and that will likely impact the company's bottom line and earnings per share once Disney does report its first quarter earnings results next month. That's according to Guggenheim. But on a positive note, the parks business seems to be thriving. The bank said it anticipates domestic park attendance to see a growth rate of 13%, and that's supported by increased travel at TSA checkpoints, along with more downloads of the Parks Experience app. And that's also despite these recent price hikes, this potential pullback in consumer spending amid a recession. People are still going to the parks, they're still spending money. The parks just continues to be this lifeline for Disney, and that's going to help them as losses accelerate in DTC. So a lot to look forward to in that earnings report.
Yeah, it's really amazing that consumers are still spending and traveling and going to places like Disney, given the cost of it and the fact that we have this looming recession, people clearly changing how they are spending. But the one thing that they remain to be spending on are those experiences, and clearly Disney a benefit there.
Huge benefit.
All right, Ali, thanks so much. Well, coming up next, taking a look at the luxury car market because luxury automakers seeing record sales in 2022. More on that when we come back.
2022 saw Wall Street suffer through its worst year since 2008. Virtually every economist is calling for some form of recession in 2023. So it only makes sense that the priciest cars on the planet, see Rolls-Royce, Bentley, and Lamborghini, are seeing their best years on record. Senior Autos reporter Praz Subramanian here with this rather interesting trend, shows two separate economies. Hey, Praz, what's going on here?
Yeah, Dave, I call it a tale of two markets, really, right? You have this high-end luxury market doing well here in 2022 while the market or the economy slows down. Start off with Lamborghini. Deliveries up 10% last year, topping 9,200 cars. The Lamborghini CEO told us earlier this year that they're selling more cars than they can actually make. That's how strong the market is. Bentley, their VW portfolio made another record-breaking year, third year in a row, record sales, up 4% to 15,000-ish cars. CEO Adrian Hallmark told us that he's never seen spending patterns like this before with the luxury consumer. And finally, Rolls-Royce yesterday, we heard from them. They had a record-breaking year, 6,000 cars produced. Their clients are actually getting younger and more wealthier. And they're actually at 42 years old, average age, that's younger than Mini drivers.
Wow. That, I feel very, very behind the eight ball here. A lot of people in their early 30s are able to afford those types of cars. So, Praz, that's an extremely high end of this market here. Let's talk about the other end, and that's used cars, because we certainly have seen prices pull back quite a bit last year. How big of a drop have we seen, and what does that mean that we'll likely see this year?
So yeah, we had that 2021, saw a huge rise in used cars. Used cars typically entry-level cars, people that are looking for affordable wheels. Those went up so high. And then finally, we see here the Manheim Used Car Vehicle Value Index showing that in December, the actual index came down almost 15% year over year. That's the biggest decline in the history of the index. So we're seeing that market really correct. Jonathan Smoke, the head economist at Cox, which owns Manheim, said that they're seeing unprecedented declines here, but this also followed huge gains. We'll see equilibrium hit the market and moderation this year. But I feel like we could see this market go even lower as the economy may slow down as the Fed continues tightening and things like that.
All right, moving over to the EV space, Praz. Wall Street Journal reporting several executives leaving Rivian in recent months. What's behind the departures?
Yeah, a report this afternoon about this. Two major departures here. Randy Frank, VP of Body and Interior Engineering, along with Steve Garanowski, the VP in charge of Parts and Purchasing. Both apparently gone at the beginning of this year. Also gone to the head of strategy and general counsel. We reached out to Rivian just now to get comment. Haven't heard back from them yet, but want to note that Rivian just missed their production forecast for 2022 of 25,000 cars after they struggled to get enough parts to make vehicles. So there you go with some of these departures following that year of production.
Stock off about 80% in the last year, so certainly it's been a really challenging road here for Rivian. Praz, thanks so much. Let's take a look at another big mover, and that is Southwest. Following its holiday travel disaster, Southwest Airlines trying to get back in good graces with its customers, this time via a huge fare sale. Now, the airline selling one-way tickets for as low as $49 between the end of this month, January 31st, through May 17th. Of course, there are some rules to this. You have to book 21 days in advance. You have to buy your ticket by this Thursday at midnight. And there are blackout dates for some domestic and international travel. Southwest stock moving a bit on this news. Taking a look at the intraday move, we looked at gains of just over 1.5%. But Dave, I don't know whether or not this is going to do the trick. I think a lot of customers are fed up with Southwest. They're demanding answers. They want to see more changes. Yes, a fare sale is a step in the right direction, but those customers that have been impacted during the very important Christmas holiday time period, I'm going to think that they're going to want something more closer to free flights.
Yeah, 16,700 flights canceled in that devastating period. And quite frankly, I've been trying to search for these $49 fares, and it kind of feels like the frustration that passengers found trying to get reacquainted with their luggage. Some, by the way, still have not over the Christmas holidays. I could not find a single $49 fare. I did look 21 days out. I did look Monday through Thursday. I checked several different cities over the course of 3 different months. And again, I did not find one fare for $49. I found one for $54. Just about everything else in terms of a one-way route was north of $110 or $141. This appears to be on its surface a marketing gimmick that is certainly not going to work. what is going to solve this? It's going to take quite some time. They say it could cost them that devastating meltdown, $825 million on their bottom line, about half of that in terms of lost revenue for all those 16,000 plus canceled flights. Who is to blame here? What is to blame? That outdated computer system that was largely the fault of all this, we still haven't heard from Southwest. Is that going to be replaced? Now, a lot of the blame has gone on the current CEO, Bob Jordan, but some are starting to speak out about their former CEO, Gary Kelly, who is still, Shauna, the executive chairman, and some feel is still a large influence in the problems there at Southwest. Largely speaking, no. These $49 fares are not going to solve Southwest's many problems.
Yeah, certainly. There has been a lot of criticism placed on both Gary Kelly and on Bob Jordan over the last several weeks. The company has made some executive changes. They've appointed 5 new leaders or promoted them into new positions following the disaster that happened at the end of last month. But I don't think that's going to do the trick. It's one interesting part, though, is the stock performance during all of this. Where we are today, we're only about 3% below where we were heading into the holiday week. So the fact that we have been able, or the stock has been able to weather this maybe better than most were anticipating, is something that we certainly should highlight there, with the stock closing today back above 36 bucks a share.
Well, if anyone out there has found a $49 fare, congratulations to you. Please let us know. Tweet us at Yahoo Finance, at Dave Brigg TV. I would love to see the receipt, or at least some form of proof that someone found one, because I am striking out. But again, there's no hub for Southwest Airlines, so it's hard to even trace where those routes will be found, and no hub was part of the problem that broke down that whole system. But a long road ahead for Southwest. Lots still to come here as well. M&A optimism on the upswing this year. We'll tell you where the deals might be. Stay with us here on Yahoo Finance Live.
M&A activity taking a huge hit in 2022. Global deal making dropping 37% from 2021 levels, and Q4 marking the lowest volume that we've seen in about 6 years. So what's in store for the year ahead? Citizens is out with this 2023 M&A outlook, and here with more on that, I want to bring in David Dunstan, Citizens Managing Director, Head of Industrials. David, it's great to see you here. So certainly we saw significant slowing in M&A in 2022, of course, coming off what was a pretty hot 2021. But what does 2023 this year have in store?
Well, the survey certainly suggests that company owners and executives, as well as private equity partners, feel bullish about activity levels and expectations for 2023. That sets the stage for a much better environment than what we witnessed in 2022. The survey itself includes 400 respondents, so we have 275 C-suite executives, as well as 125 PE partners who have their finger on the pulse of what's happening with their companies and in the environment in general. So we're enthusiastic about the optimism despite some headwinds as we enter 2023.
And if we could, David, let's jump into some of the sectors where we think we might see some M&A activity.
Absolutely. So, for example, I run the industrials group at Citizens. We have 9 or 10 different industry verticals across our platform. As you look at industrials, for example, we see the effects of reshoring. We see the effects of the infrastructure bill, the impact of electric vehicles, electrification of the grid, the demand by data centers for equipment and infrastructure, as well as automation. These are 1, 3, 5, 10-year type incremental cycles that we think are very important, driving deal activity for manufacturers of equipment, parts, components, service providers, as well as distributors of these materials. So in the industrial space, while there may be some volatility quarter to quarter as the M&A market operates more on a longer term perspective, we feel really good about that platform. In addition, we saw bullishness in aerospace and defense, business services, and seeing expectations across various verticals for a much better environment for deal-making activity, given some certainty around interest rates, around the possibility of a recession, and comfort with regard to company performance based on the feedback and statistics we're seeing in the survey.
David, what about valuations? Because 2022, the worst year for stocks that we've seen since 2008. But reading through this survey, company valuations are expected to stay stable or higher. 80% of company valuations expected to stay stable or move higher, which is pretty optimistic given all that uncertainty, given the fact that the Fed saying it's going to remain aggressive, rates remain high, inflation still has a ways to go in terms of easing. Why are we seeing that optimism?
Well, it's interesting. Another statistic in that survey suggested that over 90% of the companies are expecting their company performance to be better than last year as well. And again, I think there's what we have seen over the last few years is real resiliency in companies. They've overcome the effects of COVID, supply chain, raw material, labor, a war in the Ukraine, for example. In 2022, we saw the effects of interest rates increasing, leverage finance pullbacks, et cetera. These things have been challenges companies have continued to address, face, and determine how to operate within that environment. As we enter 23, we feel as though from the survey results and our own practice, business owners, PE executives, capital markets participants are getting more comfortable operating within this unusual environment. And that amount of comfort and certainty with regard to thinking about a forecast, thinking about projections, thinking about performance gives people comfort that you can get deals done and get them done at a reasonable valuation, as good or better than what the expectations were in 2022.
David, you talk about resilience, but there's also been some resistance on a federal level to some of these major acquisitions. And of course, I'm talking about Microsoft and Activision Blizzard and the publishing action between Penguin Random House and Simon & Schuster. Has there been any type of chilling effect from those federal actions?
Yeah, there's no question that there's been a little more increased scrutiny with regard to the regulatory environment. We're seeing that across the board with regard to HSR and getting various approvals, CFIUS, other matters that fall into that regulatory environment. That does create some challenges with regard to deal making, but like with regard to interest rates, with regard to COVID supply chain, raw material prices, et cetera, deal makers, advisors, lawyers, executives, we're finding our way through that minefield. Sometimes it's taking a little longer. There's a longer, more in-depth review process, but overall, for the most part, so there are some high-profile deals that have been blocked or roadblocks have been put in place. But for the most part, we are finding our way through that maze and making progress despite some of the regulatory headwinds that you have to throw into the mix here as well.
Good to hear things could open up in 23. Citizens David Dunstan, good to see you. Thanks so much. All right, we'll talk some real estate after the break. More home sellers are really sweetening the deal when it comes to negotiations. We'll find out how they're doing that when we come back.
Former Trump Organization CFO Alan Weisselberg has been sentenced to 5 months in jail for his role in years-long tax fraud scheme. Now, Weisselberg, as part of a deal with prosecutors, pleaded guilty to 15 felonies and has agreed to testify against the Trump Organization. He also paid over $2 million in taxes and in penalties. Weisselberg is expected to serve his sentence at New York's infamous Rikers Island. Dave?
All right, thank you, Shauna. The combination of hot inflation and rising mortgage rates have really frozen the real estate market on both ends. One way to heat things back up, well, sellers are looking to give concessions away. Let's talk about this phenomenon with Redfin Deputy Chief Economist Taylor Marr as part of our real estate report brought to you by Intuit TurboTax. It's good to see you, Taylor. So let's talk about these concessions. First, historically speaking, how significant are these concessions and what types of things are sellers giving away to buyers?
Yeah, thanks for having me on. I really appreciate being here. So what we've seen is a huge increase in concessions given to buyers in order to close the deal. Sellers are having a really tough time out there. What we see in Redfin data is that 42% of recent offers had a concession where the seller gave money back to the buyer in some form. And that's up from about 30% or less historically. So it is a record high, and we're seeing this really increase. Concessions can amount to $5,000 or $10,000 on average to basically go to fix a roof or pay down a mortgage rate and make it more affordable for the buyer to have that mortgage.
Are there particular markets where you're seeing this more so, and where are they?
Yeah, certainly. So the markets that are cooling down the most in reaction to higher interest rates and inflation and the weaker economy, those are all out on the West Coast. We see in the news a lot of tech layoffs. It's impacting places like Seattle, San Francisco, Phoenix, San Diego, Vegas. Those are all markets that have seen a big increase in these concessions. And overall, they're cooling down fast. So these are ways that sellers are trying to not have to lower their price too much.
Taylor, why are we seeing the opposite go into effect? Cities where we are certainly not seeing this, according to your data: Austin, Philly, New York City, and Chicago. Why do you think that is?
It's a great question. You know, concessions are more common when the market's cooling rapidly and ones that are more sensitive. So where we see prices falling the fastest. So these are places, Chicago, New York, Philly. These are also places that have been a bit more resilient. We haven't seen the market cool down as rapidly. They've been more stable. Austin's a weird exception, and I'm not exactly sure why we're not seeing more concessions. I think one reason might be because sellers are actually aggressively cutting their price rather than giving it back in the form of concessions. And it had a big boom in equity and real estate prices. So sellers might be just a little bit more willing to cut their price aggressively in Austin.
I've heard of some concessions being made where they are waiving inspection, which this real estate agent urges you not ever to do, no matter how desperate you are. So the question is, are these concessions enough to kind of thaw this frozen market? And that comes down to mortgage rates. What point do you think mortgage rates will get some action going again, and when do you see them leveling out?
That's an excellent question. Mortgage rates have been the key driver here in both cooling the market and, you know, what will be the key factor to bring buyers back in. I think this Redfin data about sellers' concessions actually points to some really good news that buyers are able to get a better deal than might be realized when you first just look at the data of what they could afford. They're getting significant points paid onto their mortgage to make it more affordable. And what is likely to happen is we expect in 2023 that rates will continue to decline. In fact, after Friday's jobs report, we saw a big drop in the bond market affecting mortgage rates. And so already we think that's going to bring some buyers back, and they might be encouraged to know that there's a lot of homes that are dropping their price out there. They might also be able to get some concession. Now, I did mention these amounts are relatively small, about $5,000 on average, but that could be more advantageous to a buyer than a $5,000 price cut. So buyers are a bit more willing to negotiate in a seller's concession than they are to accept a lower sale price or get a bargain that way. And so it might actually be worth more both to the buyer and the seller that way. And at the same time, you know, as the market starts to recover a little bit when rates fall, we'll start to see this moderate out too.
And speaking of home prices, Taylor, some have had some very dire predictions about the year ahead, talking about a 20% peak to trough. How significantly do you think the drop will be nationally in home prices in 23?
So our outlook for 2023 is that home prices will fall about 4% relative to the previous year. That will certainly be sharper in some metros. In Seattle, San Francisco, home values have already fallen more than 10%. And there have been some segments of the market where values have fallen 20 or 25%. So there's definitely weakness out there reacting to the market conditions. But overall, nationally, things still aren't going to be that dire compared to 2008. So our outlook is that even as prices decline, there will still be some affordability challenges for buyers out there. And, you know, we'll be in a tough market for at least the first half of the year.
All right, Taylor Marr, great to have you, Redfin Deputy Chief Economist. Well, coming
Thanks
up, Coinbase is slashing a fifth of its workforce to combat the crypto downturn. We'll talk to an analyst with an outperform rating on the stock next. Coinbase shares closing up about 13% today after announcing plans to cut 20% of its staff. And now the stock, though, has been under a tremendous amount of pressure over the last year, off about 80%. Well, ahead of this announcement today, our next guest warned about the cuts in his latest note that was published yesterday. So we want to bring him in. Owen Lau is Oppenheimer's executive director. Owen, it's great to see you here. You nailed it. You said that we needed to be prepared for Coinbase to cut further, and talking about layoffs, talking about what has certainly been a crypto winter, and it has been weighing on the stock. What do you think of the size of the cuts today? Is it enough?
So first of all, thank you for having me. So you just got it. We published a note. We said that Coinbase should cut around 20 to 30% of the workforce, and it came in at around 20%. To me, I think it's enough for now based on current trading environment, but longer term, I wouldn't be surprised if they do further cuts. But based on our math, their number of employees should be about like a little bit over 3,000 after this cut. So I think for now it should be enough, but we'll see longer term and how the trading volume trend.
Does this do anything to change your outperform and $72 price target on the stock?
It does not, because we had expected they are going to do something like that with the size cut. And actually, longer term, first of all, we recognize the challenging environment in the crypto space. Like, crypto winter, I think there's a crisis of confidence going on. But if you believe in this technology, believe in digital assets and blockchain, there will be some survivors. And based on our math, Coinbase has a pretty strong balance sheet to survive through this period. So longer term, we believe Coinbase can be one of the few survivors. So longer term, we remain positive on the stock.
So Owen, speak to me a little bit more about why you're bullish specifically on Coinbase. I know you just mentioned the balance sheet, but what else do they have that maybe some of the other exchanges don't? And when we talk about the potential for other exchanges to fail, when we're looking out years from now, how many exchanges do you expect to be left when it comes to crypto?
Yeah, so first of all, Coinbase has a pretty strong brand in the United States. That's point number one. Point number two, in terms of the regulations, they are more regulatory compliant compared to many other platforms. So I felt like under these more like increasing regulatory scrutiny environment, Coinbase should fare better than many other exchanges. And longer term, our prediction is there will be fewer than 5 exchanges in the world, and Coinbase could be one of them.
Yeah, their CEO, Brian Armstrong, in an interview talked about more shoes to drop in that environment. Let's talk about Bitcoin, largely speaking, very volatile last year, and quite frankly, the last few years looks to almost be stabilizing somewhere around that 17,000. We're seeing it 17,475, up 1.5%+ today. Do you see that stabilizing throughout this year? Is there more volatility to come as we see a few more interest rate hikes from the Fed?
So first of all, it's hard to predict the direction of Bitcoin. We know it had been volatile, but the volatility lost a little bit over the past few months. But I do believe that Bitcoin and other digital assets are pretty highly correlated with the interest rate direction. So if the Fed stop raising interest rate or even pivot at the end of this year or next year, that should support Bitcoin price and other digital assets. And then there are some other fundamental reasons in this space to be optimistic about this industry. So the first one is the Shanghai upgrade in Ethereum in March 2023. I think the developer said that they would keep going on for this date. And then another key event is the Bitcoin halving in March 2024. So I believe there are fundamental reasons in this space to be optimistic for the rest of this year and also going into 2024.
So in longer term, you think crypto could be an attractive player, or at least you see some catalysts there on the horizon. I think you would say that similarly to Coinbase. In the meantime, though, in that short-term duration, what do you expect to see just in terms of that trading action? Is it likely to be very volatile?
In terms of trading, I actually don't expect it's going to be volatile. I think it will be pretty stable compared to what we saw in 2021. But one thing I do feel like investors should pay attention to is rising interest rate can actually help Coinbase because they have a revenue sharing agreement with Circle. So they're sharing the interest income with a large stable coin company. So if interest rate continues to go up, Coinbase can benefit from that and offset some of the trading loss. So I do think that would also benefit Coinbase in the near term.
All right, Oppenheimer's Owen Lau. We got to leave it there. Good to have you on, sir. Appreciate that. Coinbase, not the only crypto exchange in the news today. Gemini co-founder Cameron Winklevoss in a war of words with the CEO of digital currency group, David Hollerith, here with the latest on all of this. David, what's going on here?
So we heard from Cameron Winklevoss this morning. He filed his second of what's been two open letters to DCG. And the first one that came last week asked DCG's CEO, Barry Silbert, to publicly commit to helping the company resolve an issue, which is actually related to DCG's portfolio company, Genesis. Genesis paused loan withdrawals back in November, shortly after the FTX collapse. And that's sort of been, the latest shoe to drop that we've been waiting for. And what's happened today is that Cameron came out, Winklevoss is saying that he accused Silbert of misrepresenting statements made to Gemini in relation to how the company was capitalized following an earlier loss over the summer. And later this afternoon, DCG's Silbert has responded. And in his letter to investors, where his response came from, we have important information, which is mainly that a big point of contention about how culpable the company DCG is for Genesis's current restructuring and potential bankruptcy boils down to this $1.1 billion promissory note. And that note is not callable now. That means that the company DCG would not have to return those funds in the event of bankruptcy, as far as we know at this point. As far as what it means for Genesis, we still don't have much debate there. But again, the war of words will continue to go on.
Popcorn worthy. David Hollerith, good stuff. Appreciate that. All right, Shauna, what's moving after hours?
All right, a couple of stock stories that we want to bring for you today. We have Wells Fargo and Franchise Group. Let's kick it off with Wells Fargo. A release here after hours. Wells Fargo making some adjustments to its mortgage business. They're adjusting the size and also narrowing the focus of that division. This, of course, comes amid the higher rate environment that we are currently in. Now, the bank cutting the size of its servicing portfolio, also a more focused home lending business. How they're going to focus on current bank customers and also minority communities. Of course, investors, analysts are going to want to hear more about this new plan going forward from Wells Fargo when we get their earnings report in just a couple of days. I'm sure there will be a question on that on the earnings call. Taking a look at the 3-month performances, the bank in the green up just about 2%. Over the past year, though, we're looking at pretty significant losses with Wells Fargo off about 23%. Let's take a look at Franchise Group, a headline coming out of the Wall Street Journal. This is the owner of the vitamin shop, among other retailers here. Reports from the Wall Street Journal that the company is considering going private. How are they going to do that? They're in talks to do this via a management buyout. Now, also in this report, Franchise Group exploring a deal to buy the furniture chain Conn's. We're seeing some movement in Conn's shares after hours today, but Franchise Group, you can see in the positive here today, up just about 0.7%, but over the past year, it has been a rough road here with the stock off about 43%. Dave?
All right, that's moving today. Here's what might move tomorrow. My stock to watch is KB Home. The home builder is set to release its fourth quarter earnings after the bell tomorrow. Analysts are expecting earnings of $2.87 a share on nearly $2 billion of revenue. We will be waiting to hear what KB says about demand and the impact from rising mortgage rates, as well as getting an update on supply constraints. Coming up, a grand prize for one lucky winner, the Mega Millions jackpot, over $1 billion, but you don't have to hit the convenience store to get a ticket. We'll tell you how you can get one online. The CEO of Jackpocket with us next. For the fourth time in just over 4 years, the lotto jackpot has topped the $1 billion mark. And if you're just seeing this reminder and thinking, oh no, I didn't go out to the convenience store, I don't have time, don't worry about it. You can win $1 billion without leaving your couch. You can do it right here on your cell phone through the app Jackpocket. We're talking to the CEO, Peter Sullivan from Jackpocket. Got the app right here. Peter, first, good to see you. Take us through the process. How do we go about buying our tickets on your app?
Yeah, thanks for having me. It's super easy and convenient. That's what we're trying to do here. Think of us like the Uber Eats for lottery tickets. So essentially you go on, you can either scan your ID or enter the information. We're going to make sure you're of age, which is 18 in most states, 21 in Arizona. And then what we're going to do is make sure that you're within one of the 15 states that we're currently operating in. We'll be expanding in hopefully 10 more states this year. You can go on, pick your numbers, submit it, and then you're going to get a copy of the actual lottery ticket that was bought and digitized on your behalf. The best part is you never have to worry about checking the ticket. We're going to alert you if you've won. We've already had 25 millionaires. And just over the course of this Mega Millions run, we've had over $4 million of winnings from people playing the Mega Millions that haven't hit that top prize, but have hit, smaller prizes.
Well, Peter, people certainly are using it. It makes so much sense. It's so much more convenient for lottery players out there. When you talk about how popular it is, how many people are using your app now?
So we were the #1 app this summer in the entire App Store, which is huge. But right now, in this Mega Millions run, on some of the drawings, 3.5% of all the Mega Millions tickets in the country are going through our app, and that's only with 15 states being live. We've seen in the particular states that we're live in, upwards of 15% and more of all the gameplay coming through our app. So it's been growing exponentially. This week, we're up another 143% since last week. So everyone's excited with this big jackpot.
If you're in the same sentence as TikTok, you're doing something right. Trust is an interesting factor when it comes to the lottery, in particular when it goes online. How do you convince some of the skeptics to stop going to buy that ticket and then they can trust this platform? I hear a lot of people saying, I don't trust it.
Yeah, totally. And by the way, we're not going to be able to change everyone's behavior. My dad, who's the father of the CEO, still, I find him going to the bodega to go and get his lottery tickets. So we're not going to change everyone's behavior. But for those people that are a little busy, maybe stuck at home, we had rain here yesterday in Santa Barbara. If you just want to download and order the ticket, the way that we're able to do it is we're actually locking your identity to the lottery ticket for the first time ever. And that contains a digital serial number that's attached to your account. So unlike a paper ticket that you may drop and lose, it's actually more secure. You're going to get an email that contains that serial number. You're going to get to see the front and back of the ticket. And our tickets are stored in fireproof safes because they're printed on thermal paper. So we make sure that the tickets are stored. And this is a regulated process. So we're making sure that those tickets are stored safely. Then we're going to notify you. If it's under $600 winner, you're going to get those funds directly in your account. So you can either replay or withdraw it to a bank account for no fee. If it's a big winner, and we hope we get one, we're going to contact you and you're going to work with us and the lottery to go and get your prize like you normally would.
Peter, what's going on? You got to get your dad on board. He should be your #1 customer. No questions asked.
Listen, we test all the product with him. I say, Dad, can you understand this? Do you understand what's going on? Because what's interesting is about 70% of our players are under the age of 45. But we want to make sure every time we're making a cool feature that it's someone like my dad who's been playing the lottery forever can understand.
All right, Peter Sullivan, great to have you. We wish everyone the best of luck. I got to go get my lottery ticket. I don't have to go to a store this time. I'm going to try and go on your app and use it for the first time. I live in New Jersey, and it's one of the states that you're in right now. Peter, thanks so much.
Thank you.
Dave, what do you think? Makes a lot of sense.
Yeah. Look, I've been using it for a while now, and because when I threw out that trust element, I didn't trust it initially, but since I have come to see several winners on the platform, it's given me that comfort. And I often forget to run out, and late at night, it's like 10 o'clock at night, and I think, oh no, I'm too late. So I'm a fan of it. I think it makes a lot of sense. You lose a little bit towards the fee, but that's not enough to sway me. I am in on this. I play the lottery when it gets big. I'm skeptical of you, though. You don't often play the lottery. Are you really in?
I don't. I'm going to play it, though. I'm going to play it tonight. I have to do it. I'm a woman of my word, so you can check with me tomorrow. Maybe I'll be the winner. I don't know, but hopefully. But this makes so much sense and so much easier. All right, well, that'll do it for us today on Yahoo Finance Live. If you're playing the lottery tonight, good luck. We will be right back here again tomorrow afternoon, 3 p.m. Eastern time for all your coverage leading up to and after the closing bell. See you then.